Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This bi monthly podcast is available on your favorite podcast channel. And now, let's dive into today's episode.
Thank you, everybody, for tuning in to the CFA Society India's podcast episode. Today, we have a very interesting topic on real estate investment trusts, or REITs as they are called. And who better to speak about REITs than Vishal Chandirmani? Vishal is the Chief Operating Officer and Managing Partner of Products at Trust Plutus Wealth Managers. He has over 17 years of work experience in financial services and consulting and has worked with marquee firms like Religare Macquarie Wealth, ASK Wealth Advisors, and McKinsey and Company before joining Trust Plutus. He's an MBA from the SP Jain College or Center of Management and is also a chartered financial analyst from the CFA Institute. So, as you can see, Vishal is the right person to talk to us about REITs. But Vishal, before we actually get on to the meaty topic of REITs, I would like to ask a little bit about yourself and tell us, something that is interesting that most people don't know about you on the personal front.
Thanks, Sandeep, for having me on the show. So I've been part of Trust Plutus now since the company was formed in December 2010. A lot of people may not know is that I like listening to, old Bollywood songs, and it's something that helps me unwind and just kind of relax at the end of a stressful day or during the weekends.
Lovely, lovely. So probably at the end of this podcast, we will play a very good Bollywood song for you before we close. But
Sure.
now let's move on to the main topic of the day. And before we again jump on to the real estate investment trust, I would like to know a little bit more about Trust Plutus's approach towards managing your clients' wealth.
Sure. So, the first step in terms of managing anybody's wealth is to understand the risk appetite of a client. And when we talk of a client, we're talking of a family over here. Apart from risk profile, to understand the time horizon of the investments, and accordingly create a suitable asset allocation for the investors. And once you have created the asset allocation, most of these HNI families already have existing investments. So what you need to do is, check whether the existing allocation is in line with what is recommended and suggest suitable changes in the allocation. You drill down one step further, the allocation gets broken up into various products. So if you say there should be an X percentage in equities, you could invest into equities through multiple routes, direct equities, mutual funds, PMS, AIFs, etc. Right? So that's the next level of drill down, and again evaluate the quality of investments in the existing portfolio vis-a-vis what you would recommend. Once you've done that and curated the portfolio, it's an ongoing exercise in terms of monitoring the portfolio and rebalancing from time to time, because markets do change. Views on various asset classes do change. So it is something which is not a one-time activity, but a constant ongoing process. And that's what we typically follow in terms of constant review of portfolios and giving recommendations to our investors.
Lovely, great. So very good, Vishal. So while most of us investors know a lot about investing in mutual funds, equity, fixed income, and other products, but real estate investment trusts or REITs or in your infrastructure investment trust or InvITs are a very relative new investment option in India. Could you elaborate a bit more on what they are and how they work?
Sure. So while REITs are a relatively new concept in India, they have been around as investment products in the developed markets now for several decades. Very simply put, a REIT or a real estate investment trust is basically a portfolio of real estate assets which generate income and provide regular distributions to investors. In the Indian context, the REITs which have hit the markets comprise of commercial properties as opposed to residential, because like we are aware that in India and mainly in the tier one markets, given the high cost of residential properties, the yields on residential real estate are extremely low. So bulk of the REIT portfolios that are there in India comprise of commercial real estate where the yields are reasonably attractive from an investment point of view. However, in the developed markets, you could have REITs which also comprise of residential assets, condominiums, etc. So it is an asset class which is far more evolved in the developed markets and is pretty new in the Indian markets. The first REIT IPO happened in 2019, which was the Embassy REIT. So it's just a 4-year-old asset class, but something where awareness is increasing pretty rapidly, and so is participation.
Perfect, perfect. So this is something very useful for a
Mhm.
lot of our audience as well. So what Vishal was mentioning is residential assets where a bulk of the Indian population has their investment. As per an RBI report, 76.9% of Indians' wealth is invested in residential real estate, which gives a paltry 2 to 3%. But tell me, Vishal, why have the Indian retail investors or family offices not invested in REITs to the proportion that they should have? Why is still 76.9% of household wealth still invested in residential real estate? What is your opinion on this?
So it's a changing trend. Like we said, it's a new asset class, right? It's been in existence only for 4 years. That was the first IPO, and then you've had a couple of more REITs getting listed in due course. Um, Investing into direct real estate and residential real estate has been one of the favorite asset classes for Indian investors, right? If you see historically, traditionally, most Indian investors would invest in properties or in gold, and that has changed over time. It'll take some time for people to not invest in direct real estate but invest in REITs, which is also an investment in real estate but in a demat form, which is easier to invest into smaller units, smaller ticket sizes, etc. So there are several advantages of investing in REITs, but it will take time for people to adapt to that change and to understand, because again, it's a portfolio of commercial real estate as opposed to residential. And somewhere the Indian population also has this notion of, when you own an asset, you can touch and feel the asset or stay in the asset, right? Which doesn't happen in any of your, demat oriented investments, whether it's shares or mutual funds, etc. So that mental shift has to happen to investing into real estate also in a dematerialized form and in a portfolio form rather than a physical asset.
Absolutely. So I think that is also the reason why only 2 to 5% of Indians have ever participated in the capital markets, because I believe there is a trust deficit. People like to touch and feel their investments.
True.
So I definitely understand that, definitely. But what are the advantages and disadvantages, in your opinion, on direct investments versus investment through a portfolio approach like a REIT?
So one of the main advantages of investing through REITs is um, the benefit of fractionalization of investments. So what happens is that today, if I have to invest in real estate directly, whether it is a residential property or a commercial property, I would need to invest a few crores of rupees. And even in that case, my investment will be concentrated in a single asset. So I don't get the benefit of diversification. Um, in a REIT, as we mentioned, it's a portfolio of commercial real estate properties which are located across several geographies in the country. So, and the investment ticket sizes are similar to shares. So you can buy one unit of a REIT. Uh, the uh, the units are listed on the exchange, so the price keeps fluctuating, but the cost of a REIT unit could be as low as 300 rupees to 400 rupees a unit, right? Um, so you could invest 10,000, 15,000, or few lakhs, whatever the amount might be in a REIT, and get an exposure to a portfolio of probably 8 to 10 or more commercial assets through that single investment. So you get the benefit of diversification, and diversification here is not just you know saying that instead of one property you're investing in 10 properties, but also in terms of location, because these 10 properties would be located in different parts of the country. So through a small amount, you're diversifying the geographical risk as well. The other advantage is that, as we mentioned, you rightly stated some statistics from the RBI report, and the fact that yields on residential properties are hardly 2 to 3%. In the case of REITs, the way the regulations have been framed, more than 80% of the investment portfolio of a REIT needs to be in readily constructed properties which are already income generating. Also, more than 90% of the cash flows the net distributable cash flows need to be paid out on a regular basis to investors. So these are some of the regulations that SEBI has put in place when it comes to REITs in India. If you look at the yields on REITs, they are in the range of about 6.3 to 6.5% at current market prices on a post-tax basis, right? Compare this to a scenario where your GSEC is 10-year GSEC is currently at about 7.1 on a pre-tax basis, and despite interest rates having risen, you have corporate bonds which are rated in the AA category at about 8 to 9% of yields. Now these are all pre-tax, and if you apply a marginal tax rate, you'll probably go below the 6.5% that a REIT would give you on a post-tax basis. So even from a yield point of view, REITs are a lot more attractive as compared to some of the traditional fixed income investment alternatives. The other benefit is that the underlying unit value of a REIT could also appreciate over time as they add more assets to the portfolio, right? You could see an appreciation in the underlying value of REIT units because at the end of the day, it's a portfolio of real estate assets, and that could lead to some amount of capital appreciation as well. So these are the various benefits of investing in REITs as compared to directly investing in real estate.
Absolutely. Just to summarize some very interesting points by Vishal in this last session. So, you will get yields of 6 to 7% post tax. So, this is a very important point versus what you would get 2 to 3% in residential. Second, at a very minimal ticket size, 300, 400 rupees, investor can now invest in a portfolio of commercial assets worth hundreds of crores of rupees. So that is something which is really, really attractive. And you have a diversified pool. Also, from a risk adjusted perspective, like Vishal mentioned, 80% of the rental revenue that these REITs earn has to be paid out to the investors. So it is not that your rental income is going to be stopped, or these are pre-rented units. So what then happens is you definitely have cash flows coming in. You get capital appreciation on the underlying real estate as well. So this is actually a very, very good product. And could you also shed some light on the total returns that have been there in the products that have kind of been launched since 2019, like you mentioned?
Sure. So, in fact, what's happened, Sandeep, is that in the last 6 to 8 months, we've actually seen the prices of REITs correct quite a bit. And one of the reasons for this is there were some proposals during the budget in terms of taxation on these distributions, which kind of created some uncertainty and affected the prices of REITs. They reacted negatively post the budget announcement in Feb. However, some of these proposed amendments were then reversed during the final finance bill that was passed post the representations that were made. The second factor that has affected the price of REITs in the last few months or the last year or so is that interest rates have gone up globally and in India as well. A REIT is a quasi debt instrument, right? We are talking of yields over here. So what happens is that the as the interest rates go up in the economy, the yield on the REITs to keep in line with the prevailing interest rates need to also rise. And for yields to rise, the price needs to come off. It's similar to the the math that you have for a bond. So prices have come off given given these two factors. Despite that, if I look at say a couple of REITs, so Embassy is currently trading at close to the IPO price itself. So you're getting a REIT today after 4 years at the same price at which it IPO'd 4 years back. Mindspace is a little bit above the IPO price. The IPO was at around 275 rupees for Mindspace. It's currently at about 305. And this IPO was in 2020 or so, if I'm not mistaken, right? Yeah, in 2020. Despite that, like I said, as per the regulations, they need to distribute 90% of the cash flows, and these REITs have been making payouts every quarter. So there are two components of return. One is the capital appreciation and the distribution income. So in case of an Embassy, although the capital appreciation is zero, they have been distributing close to 6.5% post tax on an annualized basis. So that would be the return on the Embassy REIT. And in case of Mindspace, the return including the capital appreciation, would be close to 10%. So that is the kind of returns that the REITs have generated over this limited time frame that they've been present in the Indian markets.
Absolutely. So seems to be a very attractive product because if you really look at it, there is hard underlying real estate underneath REITs, and also it is diversified pool of assets. But of course, is there a way to identify which are the better promoters or which are the better REITs? So if you were to invest your investors' money, how do you evaluate between the different options out there, between the different companies that have taken out their REITs?
So a few factors that we would look at is, one is obviously the pedigree of the promoters. Uh, some of these REITs that have been launched in India have excellent promoters. So Embassy, the Embassy REIT was promoted by Blackstone. Mindspace has got K Raheja Group as the sponsors, and even the most recent REIT which came was the Nexus Select Trust REIT, which is actually a portfolio of malls, and that again has Blackstone as the promoter of the REIT. So you've had high pedigree promoters. Brookfield was the other which had come out in between. So again, global institutions are sponsoring these REITs, or even a Raheja Group, for example, are all high quality names. So we have comfort on that side. What we would look at in terms of differentiations are, when we look at this portfolio of commercial assets, where are these assets located? Which are the geographies in the country? What is our view on those geographies from a real estate point of view or a commercial real estate point of view? That is one aspect to look at. The second aspect to look at is what are the tenancy rates or the occupancy rates across this portfolio of properties. Obviously, a REIT where most of the units have a high occupancy rate would be preferred over a REIT where the projects have a lower occupancy rate, because obviously a lower occupancy would lead to lower distributions. You would also look at what is called the weighted average lease tenure of all the tenants, and what is the weighted average yield that you're getting. So these are some of the factors you look at. Another thing that you look at is what is the composition of the distribution that the REIT intends to make. So getting a little technical in terms of when we spoke about regular distributions by REITs, when a REIT distributes the income, all these REITs distribute it on a quarterly basis. The distributions could be in the form of three sources. So it could be in the form of dividend income, it could be in the form of interest income, and it could be in the form of return of capital. Interest income is the simplest to understand and is taxed at the marginal rate of taxation, just like any other fixed income investment that you do. In case of return of capital is not taxable right now, but we can discuss this in a little more detail going forward, because this was the technical part in the budget which actually led to some disappointment. Dividends, in case of REITs, the regulation states that if the REIT itself has opted for the new tax regime, then the dividend will be taxable in the hands of the investors. But if the REIT has opted for the old tax regime, then dividends are tax-free in the hands of the investors. Okay, so this is a big differentiating factor, because like we know, over the last couple of years, dividends from direct equities have become taxable at the marginal rate from direct equities. In the case of REITs, this exception is still there, where the dividend could be tax-free. Now, there are a couple of REITs like the Embassy and Mindspace REIT, where the dividends are tax-free in the hands of the investors. In the case of a Brookfield REIT, the dividend is taxable in the hands of investors. So it is for each REIT to decide on the composition of distribution, and within that, whether the dividend will be taxable or non-taxable. And this becomes an important factor that you look at when you evaluate, because one is to look at the distribution, which is a function of the occupancy levels in the projects. But that distribution again is at a gross level. What is important to see is then on a post-tax level, what is the return that I'm making?
Absolutely.
And that is where you also look at distinguishing between different REITs and the composition of the taxability and non-taxable aspects of the distribution.
Great to hear an expert like Vishal on this topic, because this makes a significant impact on what you would suggest to different types of clients with different tax brackets. Because if it is taxable in the hands of the investors or not, depending on their tax bracket, it would make a significant impact on which REITs they should invest in compared to the other REITs that they should not invest in. So definitely, this is a very, very important point. And thank you so much, Vishal, for sharing those nuggets.
Sure.
And again, before we started, you mentioned that you look at overall, the goals of the portfolio of the investor before you start. So would I be correct in saying that while REITs are giving good dividend returns, the historical performance of the REITs today has not really given too much of capital appreciation, which is also a function of the capital price of the underlying real estate. But having said that, can what category of stocks would REITs kind of compare to? Would it be like a mid cap or a small cap or a large cap? Can it ever be a multi bagger? What is your opinion on that?
Okay. So, Sandeep, just to clarify one point, I think I mentioned that in case of Brookfield, the dividend is taxable. I think it's partially taxable and partially taxable on the different SPVs that they have, right? So there is a small amount of tax-free yield in case of Brookfield as well, but it's much larger in case of Embassy and Mindspace. Coming to your question, and I think this is where there is generally a misconception about REITs. I would actually not classify or look at a REIT as an equity product to kind of classify it within, a large cap or a mid cap or small cap. To my mind, a REIT is like I said, it's a hybrid instrument which has characteristics of equity and characteristics of debt. The debt characteristic is basically the regular distributions that are made. So it's similar to a bond where, a bond would pay a coupon and the REITs would make regular distributions, which is similar to a coupon, if you were to so consider it. Just that the amount that is being distributed is not fixed and depends on the overall collections that a REIT gets, which is again a function of various factors like we discussed, the tenancy rates, etc. Right? That is one aspect. So that has more of a fixed income kind of a characteristic. The fact that the underlying unit's price can go up or down to an characteristic, unlike a bond where the bond prices also do go up and down in terms of market value, but eventually a bond has a maturity date and redeems at par. In case of a REIT, technically these are units with an infinite life. For an investor to exit, you would sell your units on the exchange. So you could have a capital gain or loss. What we have seen is that REITs will typically be more of those steady state investment products, which should somewhere fit in your hybrid category of, if I were to so say, as mutual funds. So the yield comes to say 6.5 to 7% post tax. You add some capital gains, you could end up with a CAGR of anywhere between 10 to 13% in the long term. So that's how I would look at it, and not really look at this as an investment where I'm expecting the underlying to kind of, give me a multi-bagger kind of a CAGR.
Correct. Exactly. It's a more steady product. It's got a little bit of stability, while not exactly secure like a bond with a fixed coupon. The coupon is more or less stable, especially with the rental leases of commercial being more sticky, given that the tenants have to invest significant amount of capital in the fit outs of the assets that they take on lease. Absolutely. Perfect. So that's great, but as you'll be aware that there are various life cycles of different assets and different products. While commercial real estate in India is relatively stable, it has not tanked, but globally there has been a lot of turmoil, and the commercial real estate globally is kind of in a little bit of a peril. What is your opinion in the Indian landscape? How stable or how volatile is this asset class in terms of underlying capital values?
Yeah, so like I said, it's been quite volatile in the last few months, and prices have actually come off by 15 to 20% for REITs. And you could attribute it to multiple factors, because most of these assets, I think there is absolutely no issue in terms of the quality of the asset. These are all grade A commercial properties, and some of the best commercial properties you could possibly have in the country that are part of these REITs. And I'm talking about across the REITs. The quality of assets is, grade A. So there's no question on the quality of assets. Um, Certain aspects which affect or have affected this asset class are the global slowdown and the hike in interest rates. Now, one of the largest tenants in case of these commercial properties across the REITs are global IT companies, and IT as a sector itself is seeing a slowdown given the rise in interest rates globally. So as a result, you would have some uncertainty in terms of whether these companies will renew their leases or uh, also lease out an additional space, an office space, and that would typically happen if the IT sector is booming. And given that there's a slowdown there, you kind of see some impact of that. The second thing is, like we said, as interest rates rise in an economy, the yields on the REITs will also have to rise to kind of keep pace with other fixed income yields. And the only way yields go up is if the price comes down. So that has affected the capital appreciation, similar to what would have happened if you were holding a bond. So the market price of the bond would have come down when interest rates are rising in the economy. So that is the second factor. The third factor that has affected the price of REITs is that many of these REITs are also expanding their portfolios. So Embassy, for example, has 7 to 8 million square feet, which is still under construction and development. Once that gets completed, you will have additional space to lease out and earn rental incomes from. But while they are undergoing this construction, they do raise debt to acquire the additional land parcels as well as for the construction. So there is a cost of interest that gets built in. And whatever rentals you collect, you need to first take care of the interest cost, and then you have the net distributable amount. So as interest rates go up, again, the cost of debt goes up. So in the short term, there could be some hiccups over there. So there are these various factors which kind of have acted as negatives for this asset class. But I'm not too concerned about them. I think if you look at it from a long-term point of view, despite all these challenges, the asset class is still giving you 6.5 to 7% post-tax, even if I take out the capital appreciation part and keep it at nil. So from that point of view, I think it's extremely attractive. One other thing to keep in mind, Sandeep, is that uh, you rightly mentioned that the lease rates are more sticky when it comes to commercial properties. Typically, tenants have a 5 year, 7 year lease agreement. And what happens is when these leases come up for renewals, there is a certain amount of escalation that gets built in because over those years, the price is probably below what is the prevailing lease prices in the micro market. So the moment leases get renewed, you will see a sudden jump or an uptick in the collections that happen, which also reprices the amount that is being distributed. And these happen in cycles. So it happens with a lag. So once all these things get factored in over a longer period of time, I think it's an extremely attractive asset class that one can invest into. And I look at it positively that you're getting the same asset at a price which it was at 4 years back. And the fact that they've added more square feet of leasable area over the last 4 years. So to me, it's similar to the equity markets giving you an opportunity to enter at a lower level.
No, absolutely. So Vishal has painted a very good landscape in the canvas, wherein there are so many multiple factors that determine the price of the REIT. So one, of course, is the kind of rentals that are being earned, but there is also an interest component that may be offsetting some of the rentals because there are additions of space that are coming in. The REITs are kind of expanding, and they're taking debt for that. That debt has an interest cost, which kind of would get then nullified against the rentals currently being collected. But despite that, they're still giving a 6 to 7% yield. So whenever these projects are completed, the completed projects A will kind of uh, again start generating revenues and should push up the yields and hence the underlying price of the REIT as well. So pretty interesting play of dynamics going on over there. And thank you, Vishal, for giving the experts' view and insights into this. So I think that's something very interesting. Would you like to add anything else, any myths or misconceptions you like to bust, or what are the common mistakes that investors do while making investments in REITs? Anything that you would like to share beyond whatever I've asked?
I think one of the most common mistakes I've come across when any of these REITs have come to the market during the IPOs is that being a new asset class, I understand that the awareness is limited. But I've heard of a lot of cases where this asset class during the IPO is being sold as an equity IPO, and in turn the return expectation from investors is that I can sell this on listing and make a quick buck, just like you would do in probably equity IPOs when the IPO market is good. So someone would take leverage and invest also, and think that I'll make 10% on listing or 15% on listing, like possibly you could do in some equity IPOs. But and then those kind of investors have actually faced disappointments when the units have actually listed. I think it's important to understand that this is not equities. It is, like I've been saying, it's a hybrid product which has some characteristics of equity and some of debt, and is a lot more stable than equity. So you should not be expecting any listing pop in this kind of an asset class, and kind of taking too much of leverage and investing purely to sell on the listing day and make some quick gains. I don't think that really happens in the case of REITs. So I think that is a big myth that people have, and you'll probably burn your fingers more often than not if you invest from that perspective. Invest in it as a long-term product where the primary aim is to earn the rental income or the yields. Look at it from that point of view. Look at it as an asset class which can give you regular income. There are lots of investors who do depend on regular cash flow to meet various expenses or other needs. This is an excellent tool through which you can kind of get part of those cash flows. And unlike bonds, which typically pay interest on, most bonds would pay interest on an annual basis. Some pay it on a half-yearly basis or quarterly basis. But in the case of REITs, they have quarterly distribution. So you get the income, while it is say 6.5-7% post-tax per annum, but at least the income keeps coming in every quarter. So the frequency of cash flows, a lot more here. So one should look at it from that point of view and as a stable asset class, and invest into it.
No, absolutely. So by some estimates, there are $2 trillion worth of retail investors' money in fixed deposits in India. So, and of course, India is a capital scarce nation. So if some little part of that, a little sliver of that is reinvested in the infrastructure and commercial real estate of India, I'm sure it'll go a long way to develop the country as well.
Absolutely.
So, right.
Because, just to elaborate on what you're saying is, why would a developer look at bringing a REIT in the first place? Is because it helps him, release some of his cash flows by issuing these units, and that same cash flow can be used to build new projects. So it helps in obviously the evolution of the entire industry and the development of the country.
Absolutely. So till now, I think the only exit route for commercial developers used to be the global private equity players like the Brookfields and Blackstones of the world. And they are actually the biggest landlords of India today, if you look at it, because they have consumed a lot of the commercial real estate out there. But happily, what is happening is they are also offloading part of that to the retail investors in India to circulate the capital back. So that's very nice to know and hear. And thank you so much, Vishal, for the great insights during this session. And thank you all the listeners for tuning in and spending your precious time on this. Hope you found this useful, and stay tuned for more episodes that are going to be coming up shortly. And I would like to take a quick moment to also thank all the volunteers of CFA Society India for getting me and Vishal together here to take this session for you. And thank you so much for all the volunteers for spending your precious time and organizing this. That's about it. And see you next time for the next podcast then.
Thank you so much, Sandeep.
Thank you.
Thank you for tuning in. Don't forget to like, share, and subscribe. Share your feedback by sending a DM on social media. Stay tuned for the next episode.